Welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take the stock-related questions tonight, Rowan Williams from Nitrogen Fund Managers, Devin Shutte from the Robert Group. Please be sure to send your questions. Email stockwatch@bdtv.co.za, SMS 41392, X using hashtag Stockwatch. Gents, thanks for joining us today. I want to kick off. Question came through. We had Standard & Poor's upgrade us to, well, upgrade's a big word. I suppose it is. We are positive, no longer stable. We're still, I think, 3 notches below junk. Devin, let's start with you. We were saying before we came on air, it's a small step. The difference is the small steps feel in the right direction, whereas a year ago they felt in the wrong direction, perhaps. It's a good move in the right way.
Absolutely, Simon. Really, that kind of virtuous cycle of, positive news begets positive news feels like it's gaining some momentum. When we got that S&P outlook upgrade, that fed into a stronger rand, that helps inflation, that helps interest rates. So it really is great. I think Moody's and Fitch will likely follow suit, and we could get potential ratings upgrades in a year or two, and possibly even moving back to that coveted investment grade a couple of years from then. But to your point, I think the direction of travel is correct, and that's brilliant for South Africans and even better for investors.
Rowan, that is the point. We're not going to become investment grade anytime soon. Our immediate hurdle perhaps is the grey listing we're on. But it's it's that right direction. It's that little bit of positive momentum coming in behind the country as a whole, and therefore our SA Inc. stocks and bonds, of course, in the rand.
Absolutely, yeah. We can't underestimate sentiment and the power of sentiment. And what we have seen is on the ground with post the South African elections and the formation of the GNU, really, that's been the sea change, has been sentiment. More so than really economic activity in the short term. We've obviously seen the rand strengthen substantially. We have started the rate cutting cycle, but things like the petrol prices come down, pressure coming off the consumers. So you can see how it matters. Sentiment matters. Even if our bonds price more favorably, the cost of government debt comes down. And so that, as Devin said, the virtuous circle. So we do certainly seem to be going more in the right direction than the wrong direction, which will lead investors to come and invest, even South African investors to unlock their hard-earned savings and be prepared to reinvest them in the South African economy. So if we can keep this momentum going, I think we're certainly on the right trajectory.
Yeah, it is. And sentiment it's a weird thing. It's fragile, but it is all important. Rowan, next day with you, we had We Buy Car results out this morning. Good numbers. This really has been a top value creation. The stock's doubled since unbundled from Transaction Capital, probably on around about an 18 PE. Is there still value at 40 Rand where it's trading now?
Yeah, so it's certainly got a very healthy rating, as you said, particularly from the unbundling. And we're seeing that a little bit of a trend where groups are having to unbundle their valuable assets in order to, just see and expose the value in the underlying group. So the market had for some time liked the We Buy Cars story, particularly inside Transaction Capital. And what you're seeing is that as a direct investment opportunity, getting that rating, I guess that the group felt it deserved. But 18 does look pretty full. I think that just shows you how with the sentiment we've been speaking about, you've seen a lot of stocks re-rate. And so it's more about the multiple has been improving faster than the earnings trajectory, particularly in the short term. So yeah, it reflects a lot of expected growth. I mean, the new car sales have been somewhat disappointing. Used car sales a bit more defensive. So, but the business will have to continue to grow and deliver in order to justify that rating.
Devin, your take? 18's a lot, particularly when I think about CMH, that's probably on about a 6. A different business, but Motors, that's probably on a high single digit. 18's a lot. Your take on We Buy Cars, or perhaps the alternatives to them?
Yeah, Simon, I'm in agreement. It does look a bit dear here. I think the sector is probably under quite a bit of pressure, as you intimated there. I don't think the consumer is feeling particularly well off just yet, although the sentiment has improved. I think the kind of personal balance sheet still have a way to go before that kind of wealth feeling kicks in. So, this will be at the sharp end of that. I think what WeBuyCars does incredibly well is kind of disrupted that, dealer trade-in model. They aggressively growing their market share, and they've done it, by just doing it through tech facilitation and that. So, yeah, a really efficient and well-run business. My sense is you're probably going to get better valuations, but yeah, my pick in the sector for sure.
Yeah, and I take your point. I mean, it has been a lot of companies talk around disruption. WeBuyCars really is shaking up a space that was never a good experience for almost nobody. Devin, let's stay with you a moment. PPC, I mean, better. I mean, headline earnings up 22 cents from 20. Still a tough space for the cement maker.
Yeah, I mean, this really is a difficult business, or a hard business, if you excuse the pun. But yeah, I think they're talking a good game about the kind of the confidence growing in the turnaround. They're doing all the right things in terms of cost optimization and that type of thing. But my sense is we're just not seeing it in the numbers yet. Revenue's still slipping. Yeah, they say cash inflows are up. HEPS did bump up a little bit, but I think it's tough all going. And although, the sentiments from our politicians are that we want to make South Africa construction sites, there's a long way to go there. That being said, if we do really start to see that happen, they'll be a beneficiary of it. But, it's a commoditized business and it's competitive. So, yeah, they've really got to stay on their toes, Simon.
Yeah, and the one thing we've learned from politicians, it's easy to talk about construction sites, it's harder to construct them. Rowan, PPC and their results, it is a tough space. It's a highly competitive space.
Yeah, a commodity that needs strong demand really to generate returns for the producers. So this is a bit of a theme that we're seeing, where you're seeing a lot of the companies where they had some self-help and they've improved now. The second leg is really moving up, the shares moving up in anticipation of demand. So starting to discount some of the good news that is expected in the future. So more reliant on, as we said, a number of these sort of uncertainties around deliverable. And I guess if construction investment doesn't flow as expected and as priced into the stock, there's potential downside from here. So things are getting a little bit more teed up, for delivery and the need for delivery to sustain some of these share prices in the stock market rally. So I guess heightened risks versus expectations, and you may want to consider, whether the risk return sort of payoff is good at these price levels.
Yeah, I take your point. It's moving ahead of expectation, and if that falls flat, things can get a little bit wild. Devin, Rowan, staying with you a second. Question coming through about the UK FTSE 100. Is it investable now? Is it worth having a look? There are, of course, a couple of ETFs, local and offshore, tracking the FTSE 100. Is this a space that would interest you?
So, it's generally been fairly disappointing in the medium term. Even the whole Euro stocks that obviously haven't had the tech boom or rally, and the FTSE is quite heavy with the global miners, which are more exposed to China and Chinese growth, British American tobacco. So some consumer stocks. I don't think the outlook for the UK economy is that fantastic. We're seeing, like a number of the developed markets, a growing debt burden and, difficulty with prices and demand, slow growth. Personally, don't get too excited. I think you could do better looking closer to home, or maybe other emerging markets that are a bit more dynamic and are expecting growth and have a better fiscal story. I mean, could argue the South African fiscal story is better than a lot of developed markets, including the UK.
Yeah, strange thing to say, but it makes sense these days. Devin, your take FTSE 100?
Yes, Simon, look, those regional plays are inherently tough to call, right?
Yeah.
And, here it's a specific country. You've got a lot of financial stocks as well there, in addition to the resources that Rowan mentioned. Yeah, I don't see many green shoots there. I think they're far better places to deploy capital. It could be a great value play. My sense is you're probably going to have to be patient, and there's not terribly many tailwinds going for that economy at the moment. So, yeah, probably one I would skip.
Okay, we're skipping on the UK. How about Naspers Prosus? Trading update, big numbers, 82, 93, 103, 110%. Devin, staying with you. Naspers and Prosus, certainly under the new CEO, they do seem to be maybe a little less all about Tencent, but they still are very much a Tencent story, my sense is. Your take on sort of Naspers Prosus appearing?
Yes, I mean, I think that's right, but I think they are, actively looking to move away from that. That is a process, not an event, and I think they're doing it in a measured way. I think the new CEO has garnered a lot of respect and confidence from the market after, maybe some previous management missteps there. So I think the business is increasingly well positioned. They are looking for that value unlock, which slowly seems to be realizing. But I think, the one of the problems Tencent has is just being painted with this very negative sentiment brush that a lot of these, Chinese tech companies are. I mean, I heard an astounding stat today that if you take the market cap of the entire Chinese tech sector, and that you've got Tencent, Baidu, JD, all the big names, Xiaomi, fantastic companies, that's less than half the size of NVIDIA alone. So, you're really talking about massively depressed multiples, but, really good valuations and, economy growing at 5%. So, my sense is there's still some nice runway there, and I'm starting to get more encouraged by the direction management is looking to take the group.
Yeah, okay, that is an astounding stat for the day. Rowan, your take on Naspers Tencent Naspers Prosus rather than by proxy Tencent?
Yeah, so I think they are tilting the investment case more evenly, obviously a little bit less Tencent and more the rump asset, so to speak, by selling the Tencent stake and reinvesting it in Naspers and Prosus shares. So that obviously shapes the portfolio slightly differently, although 75% of the NAV is still Tencent. But we see it as optionality. You really are getting see-through to Tencent, and we do think it's a fantastic business at a reasonable valuation. And on top of that, you get it at a 40% discount. And then on top of that, you get optionality of the balance of the portfolio. The new CEO is more of an operator mindset.
Yeah.
And like we've spoken about some of these other restructurings, they're looking to shine a light on the valuation of those assets. So I think each and every asset they have in the portfolio, they're considering, and how can they maximize the value? Example is the Swiggy listing that took place last week, and has got a see-through listing on the India Stock Exchange, a solid IPO, a solid valuation, and that will start to reveal itself through the rest of the portfolio.
Let's go to a question coming through. The Mustek Novus deal, is there option perhaps for one or either on the buyout news which came on Friday? Devin, let's start with you. I mean, Mustek, there might be some time value of money. What's your think of the deal, and if there's some option there for investors?
Yeah, Simon, I mean, I think there might be, but, inherently these things price almost the minute the news is announced, and then there's always, deal failure risk tied into that. You've also got a couple options if you're a Mustek shareholder. I'm just looking here. You can take cash, you can take a bit of cash and a Novus share, or you can take 2 Novus shares. So yeah, I think that optionality might create a bit of uncertainty on the market price. I wouldn't be playing it for the M&A. I mean, I think you can look through to these businesses, probably not the most well-known ones, but I think what Novus is trying to do here is, management is saying they really rate the management team. They're potentially going to keep Mustek listed. I'm not quite sure how that works there, so it won't be delisted. But yeah, I mean, I think it's interesting. It's not one we watch particularly closely, but yeah, I don't see much opportunity at the moment with the pricing of the deal.
Yeah, I mean, Rowan, there are small illiquid stocks in the market, which means there's not many folks who keep an eye on them. Have you got any thoughts around it? Is there any opportunity, or they're just too small and too much unknown?
I think what you are seeing, which is interesting, is that the controlling Novus shareholders that actually have they're repeating the process they did with Novus, where they acquired a over 35% stake in Novus, triggered a mandatory offer, increased their holding, I think, to over 50%. So they, as Devin said, kept Novus listed, but now have done a lot of corporate action inside Novus, assets stripped it. They like these asset-rich companies as small cap illiquid counters and can really turn them around. I mean, the Novus share price has been phenomenal, over 7 Rand now. So I think if you like Novus and the Novus story and the operators, and you think they can add value to Mustek like they did to Novus, it makes sense to buy Mustek shares because it's a cheap entry point into Novus. You get it at a small discount, and you can elect to take the 2 Novus shares when the transaction is consummated. I think there's low deal risk because it's a mandatory offer. So I think it is interesting, but you have to be happy with the Novus investment story.
Yeah, and I hadn't actually looked at that Novus share chart in a while. That's an impressive looking chart. Rowan, let's stay with you. We had Astral numbers out today. I think the last bunch that we're going to be seeing from Chris Schutte as CEO. It's a volatile road for them. These numbers are certainly looking a lot better. Is there enough, I suppose, runway ahead for them to make some profit for a couple more years and see the price up, or is this really almost a trading stock?
I think it is very cyclical. So the poultry cycle, it goes through good times and bad times, partly driven by obviously one of their key input prices, maize, which we've seen has been very firm, the prices, but are expected to come down as we move to El Nino to La Nina, it looks like, and better crops. So the forward prices and futures prices for maize have come down. So they have had some firming in the pricing of the actual chickens. So it looks like the equation could improve and the margins could improve quite significantly. And I guess the consumer being under less pressure with lower rates and lower fuel prices, food prices generally. So it does look like they're going into, I guess, potentially a stronger operating cycle, which means there is, a prospect for decent profits and decent dividends, which would make it an interesting investment proposition.
The dividends are important. Devin, I just zoomed out on 10 years of chart, and it's pretty much the same price it was 10 years ago. Of course, you get some dividends along the way. Your thoughts on Astral, the numbers today and the prospects going ahead?
Yes, I mean, so highly cyclical business, and those input costs they've got very little control of, whether it's the services from municipality, the maize prices, as Rowan said. So yeah, I mean, this is not a buy and hold for me by any stretch. I think it is moving into a better period. How long that is, and are the consumers willing to pay up for that, and do those costs remain maintained? I'm unsure. It's great to see them turning it around and generating those earnings. But not one that I'm rushing in to buy at the moment.
Devin, let's stay with you. Question coming through, nice and simple. Dis-Chem versus Clicks. Which would be your preferred, if either?
I mean, I like the space, and both have been actually executing really well, slightly differently. Remember, Dis-Chem came out of the wholesale pharmacy business, actually, where I grew up in the south of Joburg, was the very first Dis-Chem pharmacy in Mondial. And they've then expanded to those higher margin goods, the health and beauty and that, whereas that's where Click started. If I had to choose one, maybe personally, probably Dis-Chem. I think that they've got the ability, although those store formats are bigger, to continue rolling out. I think their range is great. But no criticism on Clicks at all. I think both great prospects.
There certainly are. I mean, both companies, the share price is looking nice and attractive. Rowan, your pick between the two, if you were to choose?
Yeah, it's interesting because Clicks has had the sort of better earnings growth historically, so the last 5 years, that they've executed very consistently, whereas Dis-Chem made some acquisitions, they've built some DCs, a little bit of sort of hiccup in their store rollout plans, but the prospects going forward, as they sort of have got all the operational aspects in place, and it does look like the store rollouts will accelerate. The earnings expectations growth for Dis-Chem slightly better than Clicks, and on a relative valuation basis, it does actually look like the slightly more attractive one. Again, both great operators, great space. It's a question of choosing what's a better investment case at this point.
Okay, so Dis-Chem's the one there. Rowan, Telkom results out. I mean, profit was up 9.7%. And they also talk about adjusted basis up a whole bunch. Certainly, I mean, we had the two mobile operators, Vodacom and MTN, last week. Those were fairly bleak. Telkom looked a whole lot better, but is there investment case for Telkom?
Yeah, so it's always been a sum of the parts story where analysts are saying the assets that they have are significantly more value than the share price reflects. And they have been doing a fairly good job of transforming from an old fixed line operator to largely a mobile operator, data driven,
Yeah.
and then open serve with their backhaul data assets. And I think what we're seeing is this set of results actually reflecting that transformation and some of the benefits, improved free cash flow. It looks like they are winning market share in the mobile space. Their numbers were quite a bit better than the big two operators. And the good earnings, data growth, data usage growth, and ARPU growth there. So that's been quite positive. And then turning around BCX business and OpenServe, moving to next generation products. They managed to sell the mass business. So they are actually executing and starting to reflect their sum of the parts. So it does look quite interesting here. It's not expensive, sort of P of 7. And if they can execute and unlock value, there will be returns for shareholders.
Devin, your take on Telkom? I mean, this was, a long history, and at one point, I mean, the share price has been way higher levels, but it has recovered a bit. Your take on the results and the opportunity in Telkom?
Yeah, look, I mean, I think Rowan summed it up well. Not much I'd add to that, except to say, over the last 12 months, and it was quite surprising for me when going through the results, as well as with MTN and Vodacom, that it's outperformed them on a price basis. So that's been probably indicative of the way they've been managed to execute on that data-driven growth and moving away from fixed line. So, the fiber and the data growing really well. And yeah, I think, to my mind, kudos for them for what has been a very clear execution of strategy that they stated a couple of years back.
Yeah, and stated and executed. It's easy to state. It's often harder to do. Devin, staying with you, PGM miners question coming through. Is there opportunity for one of the miners, in which case, which would be the preferred? The PGM prices rallied, and then they're all the way back below 1,000 last time I checked. Devin, any excitement there for you in the PGM space?
Again, we were speaking about cyclicality earlier. These gold miners fall exactly in that. So, yeah, potential trading opportunities there comes with all the health warnings that investors should take heed of. Yeah, I think there's probably some asymmetric risk to the upside here, but be prepared for a bumpy ride. If I have to have a pick, it would probably be Implats at this stage. I think it probably has the most upside on that. But yeah, not a sector we're actively chasing at the moment, sir.
I need to go to stock picks, but quickly before I do, Rowan, PGMs?
Yeah, super volatile sector. I think at these prices, discounting slightly better PGM basket prices, which are, I think, struggling to materialize post a sort of disappointment about China stimulus. So they look sort of expensive relative to spot here, so we would also avoid at this point.
Okay, let's go to some stock picks then. Rowan, Pick n Pay.
Yeah, so keeping on the theme of corporate restructurings, the Boxer listing is imminent next week, and there has been quite a lot of excitement about that as the investment community has got to understand the Boxer investment case. And I guess the key is that Pick n Pay will retain 60% ownership of Boxer post-listing. So you can simply play the Boxer listing by owning Pick n Pay shares right now. So it does depend on how Boxer does, but I think by all intents, it looks like an interesting business with strong growth prospects, also executing really well. So expected to attract the valuation, and the Pick n Pay share price should follow.
Yeah, and by all accounts, I've heard the bookrunner's phone is not stopping to ring. People want stock in that regard. Devin, Raynet.
Yes, so this is, as you know, a very well-run SA industrial business, been around for ages. 3 key business units: the electrical cables, ICT, and defense products. We think that's a compelling portfolio of business, well-positioned, and they're expanding into the Eurozone and Middle East. But the electrical cable business is particularly interesting to us. We think they will be primary beneficiaries of the Eskom transmission upgrades and rollouts there. They've already invested in all the machinery to produce the cable, so it's just a case of waiting for the green light. And the business commands good profit margins, strong balance sheet, not a lot of debt, And so we think well positioned and capitalized for future growth.
Yeah, one of those, and not disrespect to the business, a boring one, but a boring one that executes incredibly well, which is often just really what you want in an investment. That's all for tonight's Stock Watch. Thanks to our guests, Rowan Williams from Nitrogen Fund Managers, going with Pick and Pay, Devin Shutte from the Robert Group, going with Raynet. Up next, the close. Stay tuned.